Good afternoon. We hope all of you are safe and healthy. Welcome to our webinar series to discuss the state of commercial mortgage loans 9 months into the pandemic. My name is John Schaefer, and I'm today's moderator. Our presenter today is Sean O'Connell. Sean is the Chief Investment Officer of Minnesota Life and oversees all commercial mortgage activity, private credit, and alternative investments. Please join me in welcoming Sean as our presenter today.
Thank you, John. Glad to be with you today to give you a sense of the company I work for and then the commercial mortgage landscape as it's transpired over the last 9 months. I thought I would start with some background on Securian Asset Management. We are a wholly owned subsidiary of the Securian Financial Group, a mutual holding company. Its largest subsidiary is the Minnesota Life Insurance Company, which just celebrated its 140th year in business. We have a little over 2,000 associates working in downtown St. Paul. Well, actually, most are working from home. Securian Asset Management manages $50 billion of assets, both for the parent and numerous third-party clients. A little bit about Securian Asset Management's real estate expertise. We have a long institutional history investing in commercial real estate with a seasoned team of professionals, which includes our direct lending team. While I'm here to update you on the direct lending landscape, we also invest in debt and equity in the REIT sector, along with investing into the CMBS market. In our direct lending business, we source loan opportunities through a preferred broker network with most relationships spanning more than 15 years. We underwrite every loan here in St. Paul with internal legal and closing staff. John asked me to describe what has occurred in the CML space since March, and given we have had a front row seat and where we are today. We all have our aha moments in life, and one of them for me was in the middle of March when my daughter, a student at the University of Chicago, called with a little bit of fright in her voice and asked that I come down and pick her up. The school announced that morning that finals would be online, that they were asking everybody to leave campus, and the school was shutting down immediately. The day before, Midway Airport closed down because the air traffic controllers tested positive for COVID-19. There's a bit of panic on the campus, and I could hear it in my daughter's voice. I left at 7 that night to drive down to Chicago and stayed over in Madison, Wisconsin at a hotel that we as a family stay while visiting relatives. It was late and I asked the desk clerk how many people had checked in. She said I was the 10th out of 120 rooms available. As I drove the next morning into Chicago, I looked at all the parking fields in front of the hotels and they were almost all completely empty. As we drove back to Minneapolis that afternoon, I thought what might be in store for our commercial real estate book going forward. This chart looks like a bad EKG, and obviously the Fed felt the market might lock up and intervened. With large parts of the economy shutting down, we and other lenders in the space looked at their loans in closing and had to make some tough decisions in canceling good investments, while at the same time trying not to get sued for lack of performance. We just didn't know what the ground dynamics would be on a potential funding date. We also lost good loans as we were financing buyers who had properties under contract. Many MAC clauses were used to cancel transactions during late March and April. So after triaging our pipeline, we focused on what we expected to be a surge in relief request, which we and the industry, and the insurance industry in particular, were not staffed to handle. Usually, when we get a request for relief, we require a lot of documentation, and it can take 3 or 4 weeks just to get a decision made. We decided that we didn't have the staff to handle the one-off opportunities, if you will, for relief that would be coming in. So we decided proactively to reach out to 200 of our retail and hotel borrowers with an offer of 4 months of interest only, assuming they would make the April 1 full P&I payment, of which 140 accepted. While a heavy lift internally, it was much more efficient than taking individual inbound calls seeking relief. And this was all done with the team working remotely. By the end of April, corporate spreads had rallied hard, and we and our competitors were trying to figure out how to re-enter the market. The problem was, how are we going to underwrite a new loan with all of the unknowns? Fannie and Freddie came out with a program where they would escrow the full year P&I prior to funding. Would our borrowers accept such a structure? How do we think of bans on all of the foreclosure and eviction actions that states and governors were taking? Do these state decrees impact us as a life company or only financial institutions defined by banks? And then again, what's the competition doing? The result, while we said we were in the market, we didn't quote any business for 7 weeks, and we were not alone. The market pretty much froze up.
Sean, I have a couple questions. You show here what has happened to the commercial mortgage or the CMBS market overall. I'm curious as to how your actual portfolio performed.
Well, John, better than expected when I was driving back from Chicago in March, I'll tell you that. Sitting here today, we have had no delinquencies or defaults. Of the 140 loans that took the interest-only offer, 120 of them reverted to their full P&I after the 4-month expired. We extended the remaining 20 for another 4 months, primarily in our hotel portfolio.
What explains the big difference between the CMBS market overall and your experience?
I think there's a couple of reasons. Flat out better upfront underwriting. CMBS market attracts a borrower that has a different profile than a life company borrower. So higher quality sponsors, for sure, better capitalized. And the fact is these sponsors don't need the full turn of leverage that the CMBS market gives. So lower going in leverage. And then one of the things that obviously we were able to do is proactively reach out to our individual borrowers and get in front of this. Whereas a borrower with a CMBS loan has to call into a servicer, and the primary servicer is not getting paid that much money to take inbound calls. And then that has to go to a special servicer where the fees start to accrete to the borrower. So it's just a much more inflexible way to service loans in a crisis. And this was a heart attack for the industry. And it shows up here in this slide with the CMBS market.
One last question here on this page. Do you think going forward that this experience will cause borrowers to favor lenders such as Securian going forward as opposed to the CMBS market?
Well, I've been in the business a long time, and after the GFC, that did occur. The CMBS market completely shut down during that event in the fall of 2008. And we had in our brokerage network brokers who were saying, I'll never bring a client to a CMBS execution again. But unfortunately, memories are, so I think in the interim period and shortly after, during the next year to 2 years, I think that will be of a draw to come to an insurance execution rather than a CMBS execution. Unfortunately, there is a subset of borrowers that want that last dollar and are willing to put up with the headaches on the back end.
Thanks.
So what happened during the summer? As the summer evolved, we began circling new business. Most of our life competitors were back in the market, with all of us looking at the relative value compared to the corporate market. Thankfully for this sector of the market, the Fed did not announce they were going to buy direct commercial loans as they did with corporate credit. That corporate credit backstop has continued to rally going through in the corporate market, but spreads in the CML space have held up nicely. While we may complain about the all-in yields, it's certainly a good time to sell liquidity into this market for CML loans. So in 9 months, the CM market went from completely shut down to extremely well bid. And we continue to see strong relative value compared to the public market as corporate credit grinds tighter despite record issuance.
Question, in this environment, what property types or markets is your team focusing on? Obviously, we all pick up the newspaper and read about problem property types, one right after the other: hotel, retail, multifamily, commercial office space, given the work from home environment. What are you thinking about those markets as we sit here today?
That's a great question, John. And you're right. You can't pick up the journal without seeing a headline regarding real estate in some fashion. We have a history of underwriting, and we have a thesis that all commercial real estate is seen through our lens that says everything is local, whether it's the location of the asset, the demographics, the infrastructure surrounding the asset, the history of the track record when we're looking at the financial history, operating performance of the asset. Everything's local. So one brush does not paint a solid picture here. But you are right, we don't love everything. Prior to the pandemic, we were very conservative with our small hotel exposure. For those in the audience that are not up to speed on how hotels work, over 60% occupancy, it's a cash flow cow. But once you drop below 60%, the operating leverage really comes back to bite you. And we went from February, these are general numbers, in the hotel market running around 75 to 80% full every night, to 20% and sometimes less than 20% full from March through, actually through today for some of the assets, some of the sectors inside the hotel space. So we've been very conservative with our small hotel exposure. But if you bring an opportunity into me, John, for a hotel in Chicago, downtown Chicago, I think I'm going to have to pass. Maybe I should finish with the next slide and give the audience a sense of where we see the various sectors today. Multifamily. Again, back to your comment, John, with the headlines in the paper. Urban core is under significant downward rent pressure. There has been a flight to the suburbs, both looking for more space in this work from home period, but also from everything shutting down around them. We see it here in Minneapolis and St. Paul, and it's not a good thing. We have 2,000 employees regularly in downtown St. Paul, and it gives a vibrancy to the city that isn't currently there. That's across the country. So it was really cool to live downtown. A lot of people are still downtown, but there is pressure there, and particularly on rents. I wouldn't want to be an owner of a new asset coming out of the ground in any of the urban sectors here in the country. Suburban markets are steady. Now, I say that with a caveat that downward potential without increased fiscal stimulus in the form of unemployment benefits. There are concerns of widespread evictions once state moratoriums are lifted. I'm not sure I buy into this, as apartment owners have fixed costs they have to cover. And unless there is a waiting list, they will be hesitant to evict if they can negotiate with current tenants. We have seen no stress to date in our multifamily portfolio, which is primarily suburban, 3-story older walk-up. So we don't lend to that brand new shiny tower in this space. So far, so good in this space for us. There's an affordability issue in this country. We have a huge need for affordable housing. So we think the affordable multifamily, older product like we have in our portfolio, also some tax credit transactions that we own, will likely continue to benefit from the lack of supply. On the industrial space, this is the darling industrial warehouse plus self-storage. These property valuations per a number of different indices have actually increased. There's more demand from both an equity and debt perspective for this asset class. Demand continues to outstrip supply. Property value is actually increasing. Last mile demand for older infill product. This is an interesting story, and we've have this in our portfolio, and we're just seeing it's just stronger and stronger. Clear heights in older product don't readily adapt to large distribution. You can't put robotics in a 16-foot clear height or a 20-foot clear height. You can in a 36-foot clear height brand new building with laser flat floors, but it doesn't work for the large distribution. But it works real well for staging that last mile inventory. And it's not just Amazon. Your local plumber or HVAC company wants to be close to their customers too. So the demand for this small bay, low ceiling height product is really in demand right now. Logistics and supply chains continue to develop. And we don't know if we're going to be onshoring, nearshoring, but certainly that Asia connection, there's some breakage there. So there's going to be continued, in our view, demand for large distribution. We have a large portfolio of this product. We're overweight both from an ACLI perspective. We've always liked it. We'd love to have even more. Office, this is the interesting one. This is a worldwide phenomenon. The office centers around the world change substantially. My guess is not. I'm not betting against it. I'm not going to be all in urban office right now. But I do think working from home will likely change the future office demand, but not kill it. Urban core is lagging and will lag. And you can see headlines coming out of the New York Metro where the suburban office market has positive leasing absorption, which means just new tenants are moving into the area, and they're coming out of the city. It's really going to be dependent on mass transit, and then until adoption of a vaccine has begun, it's difficult to see, being bullish on urban core. The suburban markets, I think, should benefit. We have done some new lending in the suburban markets in the office space. You drive into a parking field or a 3-story parking deck, and you walk directly into your suite. You're not staging for in a queue to get into an elevator to go 60 floors up. So I think that market will benefit, and I don't believe we're all going to stay in our spare bedrooms. One thing for sure, the 20-year secular trend in decreasing square foot per employee is over. We're seeing it right now in our 1 million square foot campus in downtown St. Paul, where while we only have 150 associates that are critical to be in the 2 buildings, there are the footprints of 6 feet distancing. There's a limitation on the amount of people in an elevator bank. We've just redid our whole HVAC for both buildings. People will invest in their buildings to get their workforce back. But there is this reimagining the workplace, flexible schedules, less density. When do you need to put your head down and not be, in a meeting? You just need to get work done. You might be at home. When you need to collaborate, you'll be in the office. I think that's how it's going to play out. Retail, I personally believe infill, well-located strip centers with retailers that fit the surrounding demographics will come out fine. This and grocery anchored centers are the bulk of our retail exposure. Interesting thing we found out over the summer with our retail borrowers that we provided the interest only relief. They were required, or we asked them and they were happy to oblige, monthly operating statements and just giving us a sense of where the vacancy, where the tenancy was going, how rents were collected. And what we saw was they were making some accommodations with their tenants, postponing rent when shutdowns required the tenant to be actually closed, redoing leases to maybe increase the lease rate for 2021, but decrease it for the rest of this year. And what we see is rent collections are trending the right way, and vacancies in this asset class have not dramatically increased for us. But we don't have big box retailers. We don't directly own any loan or own loans in malls. Obviously, those types of assets are going to be hit the hardest. Again, grocery anchored centers should survive here. We did a couple opportunities as a household to do online grocery shopping with 2 college kids at home, my wife and I. It really didn't work. One of us put a mask on and went shopping. Big box retailers will continue to be under stress from online penetration. And the decline in traditional malls has only been accelerated, and only the best should or will survive. And hotels will finish with the worst hit sector. It could be the last to recover. So we have 26 hotels in our portfolio. Most of them are the Holiday Inn Express or the Marriott mid-price where you drive to. We're seeing business travel in cars pick up, and we're seeing business travel in airlines slowly picking up. But those destination drive-tos are beginning a slow recovery. We have a large hotel in Clearwater on the beach. You can drive from Tampa, you can drive from Atlanta, you can drive from the whole southeast to the Clearwater area of Florida. That we haven't seen much degradation in the rent roll at all. In fact, they will come off their interest only here at the end of this month. The convention market, tourist sector recovery, the destination hotel on the beach in Hawaii, these sectors will be the last to open or to come back. You think of conventions and how that sequencing of the reservations occur and getting large groups of people to agree to show up, that may not come back for 2023. And then you think in New York and Chicago. I mean, I love Chicago, visiting you, John, in the summer. It's, the vibrancy of the streets are just fantastic. But you think of how many tourists that fly into this country from elsewhere. So until we have a wide adoption of a vaccine and borders opening, some of these sectors are going to be a long tail for coming back.
Yeah, vibrancy would be the last word I'd use to describe downtown Chicago today.
That's really unfortunate too. Well, compared to St. Paul, you're doing probably pretty vibrant. Maybe I'll finish with a couple of explanations on what we provide our clients to participate alongside Minnesota Life, our captive life insurance company here in this space. We have two programs. One is a single loan program where a client can agree to come into a subscription of a 50 million and then choose loans that fit their needs and buy a minority interest in those loans from Minnesota Life. We close in our name, and then we sell out a percentage of that to clients after the initial closing. It's treated as a participation certificate, which gets the right risk-based capital treatment on insurance companies' balance sheets. And then for smaller clients who don't want to put a large subscription minimum up, we have a program where we partner a number of smaller clients together with a Minnesota Life investment of at least 20% in each of the transactions that are originated in this group. We closed our first one, and we're currently looking to close our second one with new subscriptions. And then finally, just to give you a feel of the type of lending we do, one thing's consistent: we're not high leverage in our history, and solid debt service coverage. Somebody asked me, so how can you describe why your portfolio hasn't seen degradation here? And it certainly has. I'm not saying it hasn't, but we haven't seen any defaults. And why is that? Because we had, at a portfolio level, we had over 2.5 times debt service coverage. So while you can't identify individual assets at that level, some had higher, some had lower, but you think of it from a portfolio perspective, half the rent roll could get cut in half, and the tenancy would still support our loan. So we feel very comfortable where we're at today. As I said, we shut down for 2 months. We think we'll probably, with our backlog today, fund about a 900 million this year, which is just below previous 2 years. And with that, John, I'll turn it over to you.
Yeah, if we could go back to the last page, one question. I believe you mentioned that you're going to fund about 900 million this year.
Correct.
And through this date, you had done a little over half of that.
Yep.
The balance of 375 million or so, what average yield are you looking at today?
On average, about 325 all in coupon. And you think of that compared to a 70 basis point treasury, that spread is still, what we see as relative value is still much better than what we can buy in the single A or triple B market, corporate market.
Yeah, that yield advantage is substantial compared to normal times.
Yes.
Well, great. Thank you, Sean. Our next webinar will be on Thursday, December 3rd at 1 o'clock. Gene Preddy will discuss the state of the convertible bond market. We'll see you then. Thanks to all of you for joining us today.